Okay, let's jump right into the deep end today. We're talking modern financial markets, specifically algorithmic trading. And forget just picking stocks for a second. The real strategic game, especially when you're moving serious volume, is all in the execution. And a huge problem there is something called market impact, where your own buying pushes the price up against you, or your selling pushes it down. It's like fighting yourself. But what if it's not just you? What if there are multiple big players, all trying to build, say, a big position in the same stock at the same time? Well, it becomes this really complex multiplayer strategic battle. And that's what this deep dive is all about, the algorithms, the game theory behind that competitive crush.
Exactly. And the research we're really digging into today, it's a paper by Michael Kearns and Mira Shi. It builds on some foundational stuff by Neil Chris. What they do is take a simplified model, but one that captures the essence of this competitive trading, and they really focus on the algorithmic side. How do you program a computer to figure out the best moves in this kind of dynamic world? So our mission here is to give you a kind of shortcut to understanding their key ideas. We'll get into, temporary versus permanent market impact, different kinds of game equilibria, Nash, CCE, and how these algorithms actually navigate these strategic waters.
All right, let's unpack the trading game model they use first. So picture this. You've got several players, right? And they all want to buy or maybe sell a certain total number of shares. Let's say buy, for simplicity. They have a target volume?
Right, a target volume and crucially a fixed time window, a deadline. You have to get it done by time T.
Okay, so a strategy isn't just buy. It's
What?
a plan.
It's a schedule. It's deciding how much to trade at each specific moment within that time window to hit your final target volume. And it's interesting, the model allows for strategies where even if your net goal is to buy 10,000 shares, you might strategically sell a few shares at some point. If it helps you manage the overall cost, maybe manipulate the impact a bit.
Okay. And the cost comes from that market impact we mentioned.
Right.
The paper splits into two types. This seems important. First up is temporary impact.
Yeah, temporary impact. Think of it like the immediate splash you make, like everyone trying to get through a narrow door at the exact same time. It's directly related to the total volume everyone is trying to trade right now. The source describes it as sort of the mechanical effect of just eating up the orders sitting there on the book, consuming liquidity.
Okay, so if everyone trades big at once, the temporary impact cost is high for everyone.
Exactly. And that pushes traders towards, spreading their trades out. Don't trade when everyone else is trading heavily. Avoid the crowd. The example in the paper where only this exists shows exactly that spreading out.
Makes sense. Spread out to minimize the splash. What's the other type? Permanent impact.
Right. Permanent impact is a bit more subtle. It's less about the immediate crush and more about how the overall perception, maybe the perceived value of the asset, shifts over time because of sustained trading. It's modeled based on the cumulative amount traded by all players up to that point. So if everyone's been buying heavily for a while, the permanent impact reflects that the market now thinks this stock is maybe worth more.
So it lingers.
It lingers, exactly. It's a lasting change. And this creates a completely different incentive. It makes you want to trade early. You want to get your trades done before everyone else's cumulative buying pushes that permanent price level way up. You want to front run the lasting shift.
Okay, temporary makes you want to spread out. Permanent makes you want to front run. Those are opposing forces.
Totally. And the paper's cost function for each player combines these cleverly. Your cost at each step depends on your trade size multiplied by, a term for everyone's instantaneous trading, temporary, plus another term involving everyone's cumulative trading so far, permanent. And there's this key parameter, kappa, Greek letter, kappas. It basically acts like a knob, controlling the relative importance of permanent impact versus temporary. Turn kappa up, permanent impact matters more.
Got it. So each player is trying to pick their trading schedule, their strategy, to minimize their own total cost, knowing everyone else is doing the same, and all these actions are tangled together through temporary and permanent impact. That definitely sounds like game theory.
Oh, absolutely. It's a classic setup. And a core concept in game theory is finding a player's best response.
Oh, jizz.
It's the optimal strategy for you, assuming you know exactly what strategies all the other players are using. If their plans are fixed, what's the absolute lowest cost way for you to achieve your target volume?
Okay. And usually in games, we look for some kind of stability. In equilibrium, the paper mentions a few. Nash equilibrium, both pure and mixed, and something called Coarse Correlated Equilibrium, CCE. What's the deal with these different types? Why CCE?
Right, so a Nash equilibrium is that stable state where no single player can improve their outcome just by changing their own strategy, assuming everyone else stays put. Everyone is doing their best given what others are doing. Pure Nash means everyone settles on one fixed strategy. Mixed Nash involves players randomizing, maybe buying aggressively 60% of the time and passively 40%, something like that.
Okay, that sounds like the ideal solution, maybe. Find the Nash.
Well, finding a Nash equilibrium, especially in really complex games like this one, could potentially be computationally super hard, maybe even impossible in a practical sense. And that's where coarse correlated equilibrium, CCE, becomes really interesting. It's a broader, more relaxed idea of stability.
How so? Relaxed how?
Think of it like this. Imagine there's some external signal, maybe a traffic light, or a suggestion from a coordinator, or even just some public data everyone sees. A CCE is a situation where, if everyone follows the strategy suggested by this signal, no player looks back afterwards and regrets following their own suggestion, even knowing what everyone else was told.
So you wouldn't wish you'd ignored the signal and done something else instead?
Exactly. Even if you knew the whole system of signals. It implies a kind of stability that can emerge from players learning over time or responding to common information without needing perfect knowledge of each other's plans or explicit cooperation.
So maybe easier to reach in the real world, or computationally.
That's the idea. And the paper gets really clever algorithmically here. First, they show that finding a single player's best response, step one, can actually be done efficiently. They use a technique called dynamic programming.
Dynamic programming. Sounds complicated. Give us the gist.
Okay, the intuition is like planning a multi-stop trip. You know, the final destination and the deadline. Instead of planning every single turn from the start, dynamic programming works backward, or breaks it down. It asks, if I'm at this stage, say halfway through the time, and I still need to buy this many shares, what's the best path from here to the finish line? You solve these smaller end-of-game problems first, and use those solutions to build up the solution for the whole game.
Ah, breaking it down.
Exactly. And the state you need to keep track of is just how many shares you still need and how much time is left. By solving these subproblems efficiently, the algorithm finds the optimal single-player strategy in what's called polynomial time. It's feasible, not exponential nightmare stuff.
Okay, neat trick. So finding the best response if you know what others are doing is solvable. But how does that help find an equilibrium where everyone is playing well or reach this CCE state? That seems like the harder part.
It is. And this is where that kappa knob, the market impact balance, becomes absolutely critical. It fundamentally changes the structure of the game. Let's take the simplest case. Only temporary impact. So kappa equals 0. The paper proves this specific version of the game has a really nice mathematical property. It's a potential game.
A potential game.
Yeah.
Okay, what does that mean for us, layman's terms?
Imagine the game as finding the lowest point in a landscape. In a potential game, there's this sort of hidden global potential function, like the overall altitude. When any single player makes a move that improves their own cost, like moving downhill for them, the global potential function also improves, the overall altitude goes down by the exact same amount.
So everyone moving downhill individually also moves the whole system downhill.
Pretty much. And that's huge because it guarantees that simple, intuitive ways of playing the game will actually work. If players just keep updating their strategy by finding their best response to whatever everyone else is currently doing, like everyone just taking a step downhill from where they are, this process is guaranteed to eventually settle down. It converges to a stable point, specifically a pure Nash equilibrium. The paper gives algorithms for this and proves they find it.
Okay, so temporary impact alone is nicely behaved. Potential game converges to Nash. What about the other extreme, or the mix?
Well, if you look at permanent impact, or a slightly modified version of it, it relates more to a constant sum game. Think poker. The total pot is fixed. If I win a chip, you lose a chip. It's purely competitive. My gain is your loss.
Zero sum, basically.
Essentially, yeah. Now, the really key insight from the paper is what they call the decomposition theorem. It shows that the general trading game with both temporary and permanent impact mixed together, controlled by kappa, isn't purely one or the other. The overall cost function is actually a weighted blend. It's part potential game from the temporary impact and part constant sum game related to the permanent impact. Kappa sets the weighting in that blend.
Ah, okay. So as you turn the kappa dial, the game morphs from being like a potential game towards something more like a constant sum game. And I guess mixing them messes things up, loses the nice properties.
You got it. That's the crux. The paper proves that for the general case, when kappa isn't 0, or that special value of 2, the game is neither a potential game nor a constant sum game.
And the consequence?
The consequence is that those nice convergence guarantees disappear. Simple strategies like everyone just find your best response can fail. The paper gives examples where players just end up cycling, chasing each other's moves forever, never settling into a stable Nash equilibrium.
So finding a true Nash equilibrium in the general realistic case looks probably intractable, computationally just too hard.
That's the strong implication, which brings us back to the CCE.
Right. If Nash is too hard, maybe CCE is achievable. How do they actually find an approximate CCE, especially given, as you said, the potentially astronomical number of trading strategies over time?
Yeah, the strategy space is huge. Since chasing Nash seems futile, the paper shifts focus. They use techniques from online machine learning, specifically algorithms designed for no-regret dynamics.
No regret. Sounds intuitive, but what does it mean technically?
Okay, imagine playing this trading game repeatedly, say day after day. An algorithm has low regret if, looking back over all the days played, you wouldn't have been significantly better off if you had just picked one single fixed trading strategy and stuck with it the entire time instead of adapting day to day.
So you don't regret having adapted your strategy based on past experience.
Exactly. You learned effectively. And the amazing theoretical result is that if all players in game use these no-regret learning algorithms, the long-run average of the strategies they play actually converges to a coarse correlated equilibrium.
Okay, that's the link. No regret learning leads to CCE. But how do you implement no regret learning efficiently when there are trillions of possible trading schedules?
That's the other algorithmic breakthrough here. They show that a specific class of no-regret algorithms, one example being Follow the Perturbed Leader, or FTPL, can work. And the absolute key is that the computationally expensive step inside each round of the FTPL algorithm, which involves finding a kind of best response to a modified cost, can be solved efficiently using that same dynamic programming algorithm they developed for the single-player best response.
It connects back.
It connects back beautifully. So even though the space of all strategies is exponentially large, the actual computation each player needs to do in each round of learning is fast polynomial in the problem size, remember? Oh, the T222 complexity per round.
So players run this efficient FTPL process round after round,
adjusting their strategies based on past performance and these perturbed costs, and over time, the collective behavior settles into an approximate CCE for the whole game. The theory provides bounds on how many rounds you need R for a certain level of approximation.
Okay, the theory sounds solid. But theory can sometimes be, well, theoretical. They ran simulations too, right? What happened in practice? They used, like, 2 players, 5 time steps, specific volumes, and varied kappa. Then it converged fast.
Yeah, the experiments were really insightful. They found that in practice, the average regret dropped towards 0, meaning they were approaching a CCE way, way faster than the worst-case theoretical bounds suggested.
Oh, good.
Yeah, often stabilizing within maybe 500 to 1,000 rounds of this simulated play. That's much more practical than potentially millions. So the convergence is actually pretty quick in these settings.
Okay, that's promising for practical use. What about the kind of equilibrium they ended up in? Did changing kappa, that impact balance, change whether the player's strategies look independent or, coordinated?
That was one of the most interesting findings. They measured this using something called total variation distance, basically. How different is the actual pattern of play from what you'd expect if players were choosing strategies completely independently? And they found really low correlation, low TV distance when kappa was 0. That fits the theory, right? Potential game converges quickly to a pure, uncorrelated Nash. They also saw low correlation when kappa was exactly 2, that special constant sum related point.
But in between or for higher kappa?
For other values of kappa, especially larger ones where permanent impact really dominates, the resulting approximate CCEs showed significantly higher correlation. The players' strategies weren't independent anymore. They were clearly linked, intertwined in complex ways, reflecting that permanent impact pressure. The structure of the game really dictates the nature of the stable outcome.
Wow. So kappa changes not just the cost, but the very fabric of the equilibrium strategy. Whether players act alone or seem to implicitly coordinate, do they look at the total cost, the overall market efficiency, or social welfare?
They did, and as you'd probably guess, the average total cost for everyone generally went up as kappa increased. Makes sense. Markets with strong permanent impact are just harder, more expensive to trade in when everyone's competing.
Right.
But There was a really intriguing wrinkle around that kappa equals 2 point, and especially for larger kappa values where they saw those highly correlated CCE strategies emerging, the total cost seemed to increase more slowly.
Wait, slower. So high permanent impact leads to correlated strategies, and somehow that correlation slightly mitigates the total cost increase. That feels backward.
It does feel a bit counterintuitive, yeah. It's a preliminary finding, but it hints that maybe, just maybe, when permanent impact is really strong, the correlated behavior that naturally arises from these no-regret learning dynamics might actually be a way the system finds to be slightly less damaging overall compared to a hypothetical scenario where everyone tries to act purely independently in that tough environment.
Huh. Okay, so let's try and recap this whole deep dive. We've looked at how this research models the strategic game of trading when multiple algorithms hit the market at once. We saw the critical difference between temporary impact, the immediate splash, and permanent impact, the lasting change in perception.
And we learned that while simple cases, like pure temporary impact, lead to nice potential games where finding a Nash equilibrium is feasible, the more realistic general case, mixing both impacts, is much tougher. It's not a potential game, not constant sum, and finding a true Nash might be computationally out of reach.
Which pushed the focus towards that broader concept, Coarse Correlated Equilibria, CCE.
Exactly. And the crucial algorithmic insight is that efficient learning algorithms, like FTPL, which cleverly reuse that dynamic programming trick for the best response, can find approximate CCEs even when the number of raw strategies is astronomical.
Then the experiments showed this works faster in practice than theory guarantees and, fascinatingly, revealed how that kappa parameter radically shifts the equilibrium's nature from independent strategies at low kappa to highly correlated ones when permanent impact dominates.
And finally, that tantalizing hint from the welfare analysis. Perhaps those emergent correlated strategies in high kappa markets aren't entirely bad. Maybe they represent a kind of implicit system-level adaptation that slightly reduces the overall trading friction.
Which leaves us, and you listening, with a pretty provocative thought to chew on. If correlated strategies can naturally emerge from competitive algorithmic play, and might in some circumstances even lead to slightly better overall market outcomes, lower total costs, should we rethink how we view coordination? Could future market designs or even regulations potentially find ways to understand or maybe even nudge algorithmic behavior towards certain types of stable correlated patterns, instead of solely focusing on preventing any hint of non-independent action? What do you think?